Hello, all, and welcome back. Man, I was having an outstanding week last week in the markets, right up until yesterday. That's when we got that news that there was this planned attack possible coming from Iran into Israel. And what that did was drive up the price of oil, and it also just put a fear into the markets, and it drove the markets way down. Let's go ahead and have a look at this real quick. The West Texas Intermediate futures hit a session high of $87.67 a barrel yesterday on multiple media reports that Israel is preparing for an imminent attack by Iran. And this rocked the markets. This was something that the markets simply didn't like, causing that big plummet yesterday. The U.S. Embassy in Jerusalem has restricted government employees from traveling around outside of their little jurisdictions here of Tel Aviv, Jerusalem and Beersheba. Brent crude could spike above $100 a barrel if Iran directly attacks Israel. Now, and then I got to think, what's the likelihood that Iran would directly attack Israel? They seem to be very ideological in their ways, but not necessarily irrational. They tend to attack Israel through proxies and then leave themselves a little bit of plausible deniability, like, oh no, it wasn't us. So they do seem like they don't necessarily want to be attacked directly in Iran. So I don't know how likely this was, nor did I even know if Iran really has a standing army, so to speak of, or how it even stacks up against Israel's army. So I go over here to this military strength ranking, and it looks like, of course, up the top, you're going to the United States, then Russia, then China. And then, well, down here, you've got Iran down here at 14, and you've got Israel at 17. So Israel's going to hold their own. They're definitely near peer adversaries. So again, I'm not so sure they want to strike them directly, and I'm not so sure Israel doesn't want them to strike them directly. I'm sure that there's, well, if I'm Israel and I'm this close to Iran, and I know they're developing sort of like nuclear type of weaponry, maybe I'm looking for them to attack me straight on, so I can send some missiles or some planes over and destroy what I know to be uranium enriching plants or something like that. I may actually want this to occur. So this situation could escalate pretty quickly in that region, as you have one willing to bomb and one really wanting to fight back. So this is something to keep an eye on. Nevertheless, this is a show about the stock markets. So let's go ahead and talk about that. Now, I did use yesterday's down market as a way to finally add to my Microsoft position, and I used Wednesday's down market day to add to my NVIDIA position as well as add to my Amazon position. And I know what you're thinking: Microsoft, NVIDIA, Amazon. How does this guy find these companies? Honestly, I'm not sure where I find them, but I happen to find them. Now, yesterday's down day in the market at least provided a little bit of humility for me for today's video, because up until then, I thought that people that regularly view this channel would think, I'm from the future, or maybe I'm some sort of witch, or maybe Yoda I must be. But no, 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 no. I assure you, I'm just a normal guy, just like you all are, doing the best I can to keep up with this market, stay on top of things, and then use some of these simple rules that I have to somehow avoid big losses. So a lot of these rules that I use will seem a little bit like sacrilege and go against more of the tried and true investment principles. But as much as I'd like to be an investor, say like a Warren Buffett or something like that, and I'm just not. I'm more of a trader. I get in and out of the market. I see bad things in the way. If I see a train coming, I get out of the way and I let the train go by, and then I jump back on the tracks, I guess, when the train is gone. But I'm definitely more of a trader, and I need to use my own set of rules. So here are like 8 rules that I go by to try and make money in this market and try to avoid losses. Now, these are 8 rules that I use, and remember, these are trading rules. And like I said, some of these are going to seem like sacrilege, but here goes. Number 1 rule is that you're going to occasionally lose money. And this is one that I can't stand it, that people, that Warren Buffett line there, that never lose money. That's rule number 1. And rule number 2 is never forget rule number 1. Well, folks, that just isn't realistic. You know what they say: you got to spend money to lose money. And so you don't do this, because if you are one of these people that are clinging to the principle that you should never lose money because Warren Buffett's told you never to lose money, you're going to end up losing quite a bit of money because you're gonna basically do number two here, which is you're going to try to make up that lost money with the same exact stock. So what I do is when I lose money, I'm just, you know what, I goofed. Okay, fine. But if I lose it, I start immediately. I cut it. I said I don't like you anymore, stock. I don't fall in love with a stock. I don't like you anymore. Who do I like? I start looking for that new stock. And so I try to make up that money. So in a way, I guess I do Warren Buffett's principle of never lose money. But when I make that money back up, I'm just generally going to do it with a different stock. My third rule is that PE ratios aren't gospel for the trader. So in the long run, the PE ratios do matter, but in the short run, what you're expecting is you want growth companies. You want companies that are going to grow into their valuations. And so if they never do grow into their valuations, that stock price will come down. However, if they continue to grow, and some have been growing for a very long time now, consider like Microsoft, consider Amazon, Nvidia, they're able to trade at high multiples because they continue to grow. The day will come when they eventually aren't growing and they will have to trade at market multiples. But today's just not that day. Let's go ahead and look at the stocks that I happen to own in my portfolio right now. You're going to notice that none of the stocks that I hold are trading at a market multiple. The market multiple is now at 21, and that's forward earnings. And you're going to find that none of them that I hold trade under 21 times. We would say that anywhere between under 21 would be trading at a discount to the market. Anything at 21 would be at the market multiple, and anything above 21 would be trading richer than the market. So I got Amazon, Nvidia, Microsoft, Palo Alto Networks, and Shake Shack. And you're going to see that every single last one of these has a PE ratio, that's forward PE ratio, that's greater than 21. Amazon's at 45. This is the company that I'm most bullish on. Nvidia is sitting at about a 31. Schwab's going to have it higher. They always do, but really most people have it trading, they have it at 36. Most people have it trading at about 31 times. So this is actually not an overpriced stock, is Nvidia, given their growth. Microsoft, it would probably be one of the more rich ones that I have. And the reason for that is they're not growing quite as fast as some of the others on this list, and they're still trading at 36 times. You can see that their price to earnings ratio right now is 38 times, and they're only projected to be 36 times forward PE. So they're not growing at the same rate that, say, Amazon is. So this would be a really rich stock for me, but it's one that you always have to pay a premium for. It's like real estate. You're just never going to get in on Microsoft on like this huge dip. It's like Visa. There's not going to be this huge dip. You're going to have to pay a premium to add Microsoft. You're not going to be able to get it on this super great price. Another one that I own in my portfolio here is Palo Alto Networks, and this one's interesting because this one's actually got this company's got a high PE ratio, and its forward PE, unless something's changed, is higher than its current price to earnings ratio. And so its price to earnings ratio is 43, and its forward PE is 50. I think that, especially given a lot of world events with what's going on right now over in Israel, Iran, I just think that cybersecurity is real important. This is the leading cybersecurity provider in the world. I tend to think I'm more optimistic in their growth prospects than this. I know that they've given their guidance and analysts have really put it in the penalty box, but I think that that's, in my opinion, we're going to prove that that's actually false, and this company is actually going to grow. So I like Palo Alto Network. And last but not least, I always have one small gambler position in my portfolio, and this one here is going to be Shake Shack. I just kind of put it there, kind of put it away, don't think about it, don't look at it. Even when I'm looking at the market on a daily, I just forget that I even own it, because what I'm going to do is, because I will kick myself if they end up being the next Chipotle and their stock's sitting at $2,000 a share, and because right now they only have 256 stores worldwide. What if they get like 2,000 stores, like say a Chipotle or whatever, or 4,000 like a Wendy's or what have you? I'm going to kick myself if I didn't get in on the ground floor. And this is my gambler money. And you can see their price to earnings ratio is 212, and they're expected to grow wildly over the next year and get down to 141. And eventually, you'd like to think that they'd have open up enough stores to get this down in the 20s. And then last but not least, you got stuff here like this DJT. So I have a put. I bought a put against DJT. And you may say to yourself, it's sitting here at $32.38. Why buy a put against that thing? Well, it's wildly overvalued. It doesn't mean that it won't go way up, because what if, you got the Saudis out there that they got their Saudi wealth fund that wants to buy a bunch of this to kind of help out Donald Trump and his candidacy, or maybe you got the Russians, or maybe Kim Jong-un wants to become relevant again or whatever. Everybody's got their little reasons to maybe pull this thing forward. And so if you think to yourself, what is it really worth? Well, here's Workhorse Group. It's trading at 19 cents a share. And DJT this past year made about $4 million and lost $58 million, and we all know that. So if you look at the income statement here for Workhorse, we can see that it had $13 million in revenue, so roughly triple the revenues of DJT, and it had double the losses. So it triple the revenues, double the losses. But the difference is that Workhorse is trading for 19 cents, and DJT is trading for $32.38 right now. And it just makes me wonder who's buying this, right? And I didn't know if it was maybe like a meme stock, so I went over to Wall Street Bets and was like, is it these guys that are buying it? But these guys are not bullish on it at all. This is not a meme stock. This is not the same kind of stock that, say, GameStop or AMC. These guys are actively betting against this stock. And traders are betting millions that Trump media will tumble. And I myself, I never buy puts, but I have a put on this thing. So I don't know who's buying this thing. Someone is, but it doesn't mean that it can go up. But my point of bringing this stock up is this one has, well, it has an infinite PE ratio. But what they also have is declining revenues. So you don't want to get something with a massive market multiple and have it be a shrinking company at the same time. You don't want shrinking revenues and massive multiples. And this makes this such a tasty short position. Now it's very expensive to short. I only bought one put on it because they're so dang expensive. And even that one I bought $50 out of the money. I bought it when it was like $72. Now it's left $32. But you'll see where I am on that position. In this, you don't make as much money as you would think. And the only reason I hold this position open is just for this channel, so I can show you what you make buying a put on stocks like this one. But we'll check that out later on in this video. So next up on this list for me is that I never buy 52-week lows and I never sell 52-week highs. And again, I'm not picking on Warren Buffett, but again, this flies in the face of one of his rules, which is to be fearful when others are greedy and to be greedy when others are fearful. Again, this is one that I just simply can't live by. I like to buy high and sell higher if possible. I will occasionally buy low. I bought Palo Alto Networks as an example. It's not one that I break often, but I will break this one. I will actually be greedy when others are fearful, and fearful when others are greedy. It doesn't happen often, but I did make the exception in Palo Alto Networks because I do like where they are in the world of cybersecurity. If they're number one, then and they're down, I'm buying them. Let's just see what happens. And Palo Alto Networks isn't actually trading at a 52-week low. I got it when it's down, but it's not at a 52-week low. So I technically haven't even broken this rule either. I'm talking about the thing that's like diving and you just keep on just buying more to kind of average down until finally you just lost a ton of money. That's what I'm talking about. All right, next on this list is that I feel that macro is important. If you're trying to build a small portfolio, you don't want to lose money in the short term. So if you get the chance to get out of a train that's coming at you, just go ahead and get off the tracks. Wait for the train to go by and then get back on the tracks. And I know you're not supposed to time the market, and your time in the market is better than timing the market, but I don't do it that way. I can kind of see the bad news on the horizon. Like we can see that, after that CPI print that just came out, that interest rates are going to be really high, right? So what is going to be bad when interest rates are high? It's very predictable. You can see that the sector laggards this past week was real estate and financials. We know this. If you've got real estate and financials and you're gonna see higher interest rates for longer, get out of these sectors. If you're holding these positions, it might not be a bad idea to sell out of these and go into something else. What works when interest rates are high right now? Well, you want people that aren't going to borrow money. You want mega cap. Why do you think I like mega cap? They don't have to borrow money. What do you want to stay away from? You want to stay away from small caps. You want to stay away from biotech, things that rely on borrowing money to keep their operations going. These are things you want to stay away from. But right now, mega cap tech I see as a good place to go into, and that's because of our higher inflation rate. Now, what happened on Thursday was that we had that PPI report come out. And when that PPI report came out, the market was it was down, but the PPI report was very, very good. That's the producer price index. And it's actually a window into the PCE, which is the Fed's preferred measure of whether or not they're going to raise or lower inflation rates, or excuse me, interest rates. With the PPI coming in lower, we're thinking that the PCE might come in lower. It's a very dovish sign for the Fed. So I knew though the market opened lower on that day, it was going to finish the day higher. And that's why I told my friend, I got to hurry up and get to my phone. And that's when I bought some NVIDIA. That's when I added to my Amazon position. That's when I closed my covered calls that were expiring on Friday. And then later in the day when the market was up, I sold more calls. And I actually also closed out of a put position with Microsoft later in the day because I thought it would bounce higher. I didn't panic. It went way down. I thought it would come back up, and in fact it did. All right, and this actually flies right in the face of what Peter Lynch might say, because he'll tell you that he spends about 15 minutes a year on economic analysis, and that's fine. If you're a long-term trader and you're Peter Lynch and you've got billions of dollars, go ahead and do this. But if you're trying to build a small portfolio and you're trying to do it, you don't want to do it over the course of years. It's better if you have money. It's better if you're not down on like 5 or 6 of your positions. It's better to just get out of those and find positions you could be up on. In this case, I like the story of mega cap tech. And while I'm on this topic, when you've got strong jobs out there, which we had, this was like about a week ago, we've got, full employment. People, the wages are growing. So we got people spending money. Does that mean that we're going to have a good earnings season right now or a bad one? Well, we're going to have a good earnings season. And I'm betting a very good earnings season. The only thing that's going to derail this earnings season is going to be a war in the Middle East. Should that happen, all bets are off. But if that doesn't happen, I expect that with these earnings coming through that we're going to see this market going higher, which is why I'm getting heavily invested in the mega cap tech stocks. It's why I like those ones in particular. Now, the middle of May might come around, or the end of May might come around, and I might look into the future and I see another train coming, and then I'll go back into treasuries. But for now, that's where I want to hang out. All right. Next up on this list is that there are many ways to make money in this market, and I use them all. And I do that with trading options. Let me show you my positions here. So like I said earlier, I've got that DJT position. I've also got a covered call on Shake Shack, and it's up right now $102. I could have bought it back on yesterday for about $9. Probably should have done that. Palo Alto's up $69. I made $1,000 yesterday on my covered call on NVIDIA, but all told, I'm only up $69 on that position. I like to do this because it protects my long position. If I buy something, I like the thought of being able to make money on that underlying equity just in case it crashes, and it just keep ripping higher, then I'll go ahead and sometimes just cover the position or sometimes just let the position go. In the case of NVIDIA, like I said yesterday or on Thursday when the market was way down, I saw NVIDIA was going to rip higher. So I had to hurry up and close that covered call position, wait for it to go up, and then sell another covered call. And I got a pretty good premium for that. I got $1,000. So that was actually a win for me. And if you look at my portfolio last week, you'll see why I actually end up doing pretty well. And you can see that over the last 5 days, none of the indices did particularly well. They weren't really that hammered, but at worst it was down 2.5%, and at best it was only down 0.5%. But if you look at how, like, say, Palo Alto Networks did last week, which is one of my positions, you can see that that one was actually up 3.82% last week. So that one was a nice position for me. If I add Amazon here, you can see that Amazon was basically trading in line with, say, the S&P 500. It's sitting here right at the top. And then another thing that I did, of course, was I told you that I added NVIDIA. Let me go ahead and take some of these out of here. And I added NVIDIA when it was down because I liked the story of NVIDIA, so I was able to pick it up down here and then ride it back up. Now, again, I was way up on Thursday, but like it was up to $906. Now it's sitting at $881. So yesterday was kind of rough for me because I ended up losing about $2,500 on NVIDIA. But if you buy it down here and it's fine. I'm actually overall a winner this week on NVIDIA. I'm going to sell calls and I believe in the company. And these are ways that I end up making money on the market, just kind of like trading the macro, at least in the short run. And it's also some ways that, I use options in order to also further my gains in the market. And another way that I'll do is that when I feel like that train's coming down the tracks, I'll go ahead and take my money out of the market and I'll put it into treasuries and kind of wait for, like, when the water's a little bit warmer, I'll jump back in again. All right, and then another rule that I have is I'm not afraid to take small gains. Now, you wouldn't know it from this particular options portfolio here, because I should have probably closed this out, like I said yesterday, and then, waited for an up day and sold it again. But usually if you're up, 50% on something, 60%, just buy it back, get the money. You never know what tomorrow is going to bring. You never know what's going to happen. You don't want to lose out on that cash. And honestly, if you just take your small gain and you don't worry about it, when that day comes, when this expiration date comes of the 19th, you're not going to remember your call. B, you're not going to remember your strike. You're not going to remember anything about it. All you're going to remember is you made, if it was $800 and you that was what you waited till expiration and you made $500. All you're going to remember on that expiration day is that you made $500. That's all you're going to remember. And then you sell another one and then you worry about the next thing. But I like to be able to take small gains. No one ever went broke making a profit here. All right, next on this list is that you're going to be wrong sometimes, and when you are wrong, be humble enough to reserve the right to be wrong. Like, I always reserve the right to be wrong. I'm not always going to be correct. So what would be one that I had to look at? So we'll look at, say, like NVIDIA. I decided what I would do is I would go ahead and buy NVIDIA because I like NVIDIA's story. This guy at D.A. Davidson, he gave NVIDIA a downgrade, and I had to look into NVIDIA. And I guess the big knock on NVIDIA is that other people are taking market share from them, be they Intel or be they, say, AMD. But NVIDIA is not really selling a chip. NVIDIA is selling CUDA, and CUDA is a system that integrates with their chip and their GPU to give you a system with which to run a database, like a large-scale cloud server or something like that. Versus Intel's just giving you the chip, NVIDIA's giving you everything. And then they're like, well, other people are infringing on NVIDIA. Well, NVIDIA is also infringing on other people. You got these custom semis that are made by Broadcom and Marvell. Well, NVIDIA is making those custom semis, and it's kind of taking market share from those companies. So you'll see those companies come diving down. You see that Qualcomm's trying to take market share from NVIDIA. Oh, we're going to make the next AI chip. Well, be careful, Qualcomm, because what Qualcomm does is they make all their royalties with that 4G network or 5G network there, the G, and that's what they make. And anybody who uses that technology has got to pay Qualcomm to do it. And everybody's trying to figure a way around it. Be careful if you're poking the bear, Qualcomm, because if NVIDIA comes up with something that might be better than your 4G network, and everybody have to pay them in order to use their network. Or what about a PC right here? Be careful, Dell, if you want to step on NVIDIA's toes, because if they come out with a PC that has this integrated GPU and chip platform in here that you can use in your own home, who's not going to want one of those? That's going to be a very premium PC. So be careful if you're trying to take market share from NVIDIA, because they may not be the company to mess with. All right, so that's going to do it for me. That's the 8 reasons that those are the 8 rules that I live by when I'm actually doing my trades, and those are the way that I play this market. And I do it successfully for gains. There might be the day when I actually post, something and find something where I say where my trades are. I don't know if that's helpful to anybody, because the chances that you own the same stocks that I own are like zero. But if somebody likes that, I'll go ahead and I'll figure out a way to do it here on this YouTube channel, either through the comments or through another tab that I have under the thing. All right, so if you got anything out of this video, yeah, please like, subscribe, hit that little notification bell. If you'd like me to do something like that, put it in the comments, and I'll go ahead and do it. If there's no demand for it, I won't do the extra time. Anyway, have a great weekend, everybody. Bye.